Welcome to today's webinar, Keys to Investing for Retirement, brought to you by Royal Wealth Management. This is the first in a series that we'll be holding these webinars. You can attend monthly on the second Tuesday of every month, starting at 11:30 a.m. Mountain Standard Time, lasting between 20 and 30 minutes. So hopefully you can join us during your lunch break. At Royal Wealth Management, we understand the significance of supporting your financial goals and fostering a culture of financial wellness. These monthly webinars as part of our commitment to helping you pursue financial well-being by equipping you with the tools and knowledge necessary to make informed financial decisions. So before we get started, though, I'd like to tell you a little bit about myself and my firm. My name is Darren Royal. I am the president and owner of Royal Wealth Management. My firm's been helping clients pursue their financial goals for over 20 years now. Royal Wealth Management was founded to assist clients in every aspect of their financial lives. We strive to help create financial stability and security for each of our clients. We're dedicated to helping individuals evaluate their financial situations. We want to provide people with the tools that can help them make informed decisions. We offer informational material on a wide range of topics because we understand that individuals have diverse financial needs. If you have any questions during the course of this presentation, we'll provide additional instructions at the end of the presentation on how to get your questions answered. Keep in mind that information in this material is not intended as tax or legal advice and may not be used for the purpose of avoiding any federal tax penalties. Please consult your professional for specific information regarding your individual situation. So in this presentation, we're going to take a closer look at investing for retirement. So no matter what our occupations, most of us share a common goal of a comfortable retirement. Almost everyone looks forward to the day when they can retire and enjoy some more free time with family and friends and doing those recreational activities we like to do. And so the investment decisions we make in preparation for retirement are very crucial. According to a 2023 Retirement Competence Survey by Employee Benefit Research Institution, half of the Americans have tried to calculate how much money they will need to save for a comfortable retirement. Now that means half of the people have not tried to calculate how much money they're going to need for retirement. The real question is, for how long you're going to be in retirement? Many expect retirement to last approximately 20 years, but most financial professionals, including myself, recommend preparing for retirement that will last 30 years. Longevity has certainly increased over the years, and that 10-year gap may leave some people unprepared. Have you attempted to determine the amount of money you'll need for retirement? If so, are you preparing for 10 years, 20 years, 30 years? What's your number look like? Let's start with another question. How much will you need for retirement? Are you attempting to accumulate $1 million, $2 million, maybe $5 million or more as your number? Or do you have a retirement income target, say $5,000 in mind, or $10,000 a month you would need an income, or maybe it's more, $15,000? When it comes to investing for retirement, having a target amount in mind is critical. If you have no target, you have no way of measuring your progress towards the goal. Perhaps more to the point, you have to know a way of developing a strategy to pursue that goal. Without a clear retirement objective, you may be saving too little or taking on too much risk. When assessing retirement income sources, the Investment Company Institute breaks down U.S. retirement assets into 5 categories: IRAs, defined contribution plans, which are your 401ks, government plans, defined benefit plans, and annuities. Retirement assets totaled $28.8 trillion at the end of the first quarter in 2020. We're going to talk a little bit on this slide about the IRAs and annuities, and then we'll hold off on the next slide to talk about defined contribution plans. So contributions to a traditional IRAs may be fully or partially deductible depending on your circumstances. So you have to include your income, whether you or your spouse might be a participant or have the availability to be a participant in an employer-sponsored plan. These all are factors on whether you can write that or have a deduction on the contribution into a regular IRA. Distributions from defined contribution plans and a traditional IRA, they are all taxed as ordinary income, and if taken before the age of 59 and a half, may be subject to a 10% income tax penalty. So for IRAs, you have to leave that money in there until you're 59 and a half. Otherwise, you may pay that 10% penalty. Under the Secure Act, once you reach age 72, and that number will go up to age 75 over the next few years, you must begin taking a required minimum distribution. So at that point in time, if you haven't started taking income out of your IRAs, the IRS requires you to take minimum distributions out at age 72 currently, and it's going to go up to age 75. To qualify for the tax-free and penalty-free withdrawal of earnings, Roth IRA distributions must meet a 5-year holding requirement and incur after age 59 and a half. So in other words, you must hold that in the Roth IRA for at least 5 years and start taking money out after 59 and a half in order to get the tax-free and penalty-free withdrawal on your earnings. Now, you can withdraw any money that you put in tax-free because you've already paid tax. A tax-free and penalty-free withdrawal also can be taken as a result of certain other circumstances, such as the owner's death. The original Roth IRA owner is not required to take minimum annual withdrawals. Let's change and talk about annuities for a little bit. Annuities have a contract limitations. They also have fees and charges, including account administration fees, underlying investment management fees, mortality and expense fees, and charges for optional benefits. Most annuities have surrender fees that are usually the highest if you take out the money in the initial years of the annuity contract. These are meant to be longer-term holds. Withdrawals and income payments are taxed as ordinary income. So the money you put in, though, is going to be growing tax deferred. And the nice thing about the annuities, unlike the IRAs where you have a $6,500 limit for 2023 and a $7,000 limit for 2024, you also have a $1,000 catch-up on that if you are over the age of 50. Annuities do not have any contribution limits. You can put in as much as you'd like. So if you withdrawal is made prior to age 59 and a half on an annuity, a 10% federal income tax penalty may apply unless an exception applies. The guarantees of an annuity contract depend on the issuing company's claims paying a bill of it. Annuities are not guaranteed by the FDIC or any other government agency. The earnings component of an annuity withdrawal is taxed as ordinary income, and if taken before the age of 59 and a half, may be subject to that 10% federal tax penalty we mentioned earlier. The guarantee of an annuity contract depends on the issuing company's claims paying ability, and annuities fees and charges associated with the contract and surrender charge also may apply if the contract owner elects to give up an annuity before certain time period conditions are satisfied. I know I talked a lot about the fees on annuities. We want to be upfront and transparent about those, but really what annuities are for is to transfer that risk. We here at Royal Wealth Management believe there are 3 ways you can look at risk. You can avoid risk completely, which means you put your money under a mattress. You can manage risk, what might be things like asset allocation models, stop losses on your investments, things like that. Or you can transfer your risk, and that's what you're doing with an annuity. You're transferring the risk over to the annuity company and taking it off your plate for maybe a portion of your income. All right, let's take a closer look at investing for retirement. An important first step is to assess the Me Incorporated. That's to think of yourself as a company. And what potential sources of income do you expect in retirement? So if you're like many, your sources of income may fall into 4 broad categories. The first group is personal savings and investments. So these are things like your savings accounts, CDs, you may have a brokerage account, a joint account, any taxable accounts you have outside of retirement accounts would be included in this. You may also have employer-sponsored plans. Now this is your 401k or 403b at work. These are similar to the traditional IRAs and Roth IRAs we talked before. You have both a traditional 401k and you may have a Roth IRA option at your work as well. Distributions from 401k plans and most other employer-sponsored retirement plans are taxed as ordinary income, and if taken before age 59 and a half, may be subject to that 10% penalty we talked about from the IRAs. Under the Secure Act, once you reach age 72, again, if you're holding a 401k, you must start taking required minimum distribution. Contributions similar to the traditional IRA may be fully or partially deductible, depending on your individual circumstances. So distributions out of The 401k and the IRAs are very similar that have taken before age 59 and a half, you may be subject to that 10% penalty. And both of them have required minimum distribution. Now, if you're in the Roth IRA or Roth 401k, the holdings must be for 5-year requirement to occur after and to occur after age 59 and a half to get that tax-free withdrawal. Tax-free and penalty-free withdrawals also can be taken as a result of certain other circumstances, such as the owner's death, if you are part of a Roth 401k. You also may be counting on your real estate, including the equity in your current home, or you may have rental homes, Airbnbs, whatever the case may be, to help in retirement. Keep in mind that real estate property values can be significantly affected by economic downturns or changes in the real estate pricing. We saw that back in the financial crisis in 2008 and 2009. You may have other personal assets as well, such as collectibles, but also keep in mind that collectibles are considered a speculative investment that may not be appropriate for everyone. Speculative investments carry a high level of risk and when sold may have little or no value. These may include things though like art or family heirlooms, jewelry, things like that do have value that you could use in your retirement. Consider working with an investment professional to better assess the risks associated with any speculative tools you may be using. As you get to know the Me Incorporated, so your company, you need to look beyond sources of income. You need to get a good idea of how Me Incorporate operates. So look internally. Are you a risk taker or are you risk adverse? Are you comfortable with the level of risk necessary to pursue your objectives? If not, it may be more realistic to adjust your objectives. You don't want to have investments in your portfolio that keep you up at night. Are you detail-oriented, or would you prefer a hands-off approach? Do you want to dig through the financial statements of companies, or would you prefer to have a professional do that for you? Keep in mind, however, that there are no guarantees that a professional will not lose you money. Finally, are you patient, conservative investor, or do you tend to be more aggressive in your approach? All of these important considerations when you're investing for retirement. I think Warren Buffett summed it up best. Only buy something that you'd be perfectly happy to hold if the market shut down for 10 years. So one of the things that I've heard over and over from great investors like Warren Buffett is it's not always what you do, but maybe what you don't do, and being patient and not panicking in your, and stick to your strategy and your financial plan and your retirement goals. Once you've analyzed your approach, it's time to look at your ultimate objective. What's the growth plan for your net worth? One of your goals may be to make the money that you have working for you today grow to an amount you anticipate needing for retirement. As the illustration shows, a $500,000 portfolio growing at a hypothetical 6% average annual rate of return would be expected to be worth nearly $1.2 million in 15 years. Is $1.2 million what you're aiming for? Keeping your money growing at 6% average annual rate of return can be a challenging task. In fact, some may even consider investment management a part-time job. Markets may have favorable conditions during some periods, but can present challenges during other periods. Think of the most latest time during the COVID-19 when the markets crashed 35% in about 3 months. This is a hypothetical example used to illustrative purposes only, so it's not representative of any specific investment or combination. Many consider stocks to be an important component of a sound long-term investment strategy. The stocks can be volatile, and during the past 20 years, they've had periods where they have outperformed and underperformed other asset classes. For this illustration, stocks are represented here by the S&P 500 Composite Index, an unmanaged index that is generally considered representative of the U.S. stock market. Keep in mind that the return and principal value of stock prices will fluctuate as market conditions change, and shares, when sold, may be worth more or less than their original cost. Let's take a quick look at the long-term trend chart for bond yields. As you can see, near the end of 2023, the yield on the 10-year U.S. Treasury bond was near the 2006 and 2007 level. What's next for bonds? No one can say for certain, but as you consider various investments, it can be helpful to review long-term trends. Remember, the market value of a bond will fluctuate with changes in interest rates. So as rates rise, the value of the existing bonds typically falls. If an investor sells a bond before maturity, it may be worth more or less than the initial purchase price. By holding a bond to maturity, you will receive the interest payments due plus your original principal, barring default by the issuer. Many investors want to keep a portion of their portfolios in cash or cash-like alternatives, such as money market funds or certificate of deposits. Especially now, over the last couple of years, with the Federal Reserve raising interest rates fairly quickly, we've seen interest rates rise on a lot of these investments. So when allocating to these cash alternatives, it's important, though, to understand the role cash plays in a portfolio and to have a perspective on the outlook for short-term interest rates. The Federal Reserve sets the federal funds rate, which is the interest rate banks and other depository institutions use to lend money to each other overnight. When the federal funds rate is low, the interest rates offered as money market mutual funds and CDs tends to remain low as well. CDs are time deposits offered by banks, thrift institutions, and credit unions. They may offer a slightly higher return than you see in traditional bank savings accounts, but they also may require a higher amount of deposit. With a CD, your principal is locked up as well. If interest rates rise, you may not be able to take advantage of the higher rates until the CD matures. An early withdrawal penalty may apply. Bank savings accounts and CDs are FDIC insured up to $250,000 per depositor per institution. Money market funds, they typically pay dividends, which may be greater than the interest rate offered at a bank savings account or even CDs. Money market funds seek to preserve the value of your investment at $1 a share. Money held in money market funds is not insured or guaranteed by FDIC, though, or any other government agency for that matter. It is possible to lose money by investing in a money market fund, although very rarely do we see that. Let's take a look at what happens when growth plan becomes an income plan. So once you've decided to make the transition from planning for retirement to in retirement, we have to go from growing to income. As the illustration shows, a $500,000 portfolio generating a hypothetical 6% annual rate of return grew to nearly $1.2 million after that 15 years we discussed earlier. How much income could $1.2 million potentially generate? When the account holder reaches age 67, the portfolio could generate $50,000 in income. In subsequent years, assuming the portfolio continued to generate a hypothetical 4% annual rate of return, the account holder's income could increase by 3% each year. For example, when the account holder reaches age 68, the portfolio could generate $51,500. This is important because you want to account for inflation. Inflation most recently has risen to, well, it was last year over 9%, since come down in the 3% level. But as inflation goes up, your cost of living goes up, so you need your income to move up with that. So it's important to factor in an inflation component into your retirement planning goals. After 23 years at age 90, the account holder's annual income would have increased to nearly $100,000. A total of $1.7 million would have been taken in income, and an additional $425,000 would still remain to be passed to the heirs. This is, again, a hypothetical illustration only. As you build your retirement portfolio, it's important to remember asset allocation. A landmark study found that 91.5% of an average portfolio's performance could be attributed to asset allocation. In other words, how the money is allocated among different asset classes turned out to be more important than which specific securities were purchased. So how is your money allocated? Are you comfortable with the outlook for each asset that you have in your portfolio? If you don't know how your retirement funds are allocated, it's hard to know whether they can help you pursue your retirement objectives. When investing for retirement, sometimes it's encouraging to listen to what others are saying. Where some see challenges, others see opportunities. Again, a quote from Warren Buffett, he said it this way: "You do things when the opportunities come along. I've had periods in my life when I've had a bundle of ideas come along and I've had long dry spell. If I get an idea next week, I'll do something. If not, I won't. When it comes to investing for retirement, it's critical to understand the market environment and assess the potential for each asset class within your portfolio. There's a number of criteria to keep in mind as you consider investing for retirement. Here are some of the scenarios that might be familiar to you. Anthony and Selena have a growing family and wonder, how much should we be setting aside in our employer's qualified retirement plans? Dave and Christine are nearing retirement and they may ask, are stocks appropriate for people who are in their 60s? Rebecca is a widow who wants to know, what role can annuities play in my retirement portfolio? Isaac is a business owner who likes to take a hands-on approach to his retirement plans, and he may ask, if short-term interest rates remain low, should I consider a different approach to my asset allocation? All of these are great questions, and we're here to help with the answers. It's important to remember that individual recommendations will vary with each situation. There's a number of factors to consider when talking about investing for your retirement, and some are simple and straightforward, while others require more in-depth analysis. And that's where Royal Wealth Management comes in. We specialize in helping people just like you assess their investing strategies as they work to pursue their goals. We invite you to take advantage of our complimentary 30-minute consultation. You can book time directly with me by using the middle QR code and choose phone or Zoom appointment. Also, to stay up to date on our additional educational opportunities, be sure to link to us on LinkedIn. And don't forget to check out our website. There you can learn more about Royal Wealth Management and sign up for our monthly newsletters. I mentioned earlier that if you had any questions, specific questions that you would like to answered, you can email me at Darren, DARREN.Royal, ROYAL, @LPL.com, or you can give us a call at 720-733-9143. So with that, I'd like to conclude our webinar. Thank you for attending, and I hope to see you at our next webinar.